All right, so let's talk specifically about this bill. And one of the ways that they're doing it, and I want to get to, because you had you had a piece out today about this bill in terms of the office of the OMB, or I should say the CBO, sort of scoring this bill. But before we get there, let's just talk about, you mentioned a threshold. And that it expands the threshold. And so one of the ways that they're doing this, I want you to get a little more in depth on what the implications of that threshold. But we should also note that one of the ways they're doing this is simply saying, like, okay, we've expanded the definition of community bank, right? Like, you might think it's a small community, but community could be wherever your heart is. And that's the way we expand it.
Right. So they've expanded the threshold up to $250 billion. Now, so the context is that countrywide, when it was issuing 1 out of every 5 mortgages in this country, was a $200 billion operation. It had $200 billion in assets. So they would be exempt from all of this particular regulation, despite the fact that they failed miserably and helped trigger the financial crisis.
What is the suite?
National City.
What is the suite of regulations, though, for people under that threshold?
You're talking about extra capital, extra liquidity requirements. In other words, holding reserves that can absorb losses. You're talking about extra supervision for risk management standards, so that more bank examiners will be in your bank, seeing that you have proper risk management controls. And it adds stress tests, so that there are tests to see whether you could survive an adverse economic scenario. So those are the main enhanced standards that we're talking about.
So it all boils down to basically like, hey, dude, you only make $3,000 a month. You can't go out and be, charging $6,000 a month on your credit card, more or less, right? I mean, they can't. You can't go out and invest and speculate on things where you don't have the money to cover it.
And here's the thing about these stadium banks. These are the early warning system for our financial system. When a stadium bank like a Countrywide or National City, which was about a $150 billion bank when it failed because it was a big subprime lender during the crisis, or GMAC, which required a huge bailout and during the crisis, it was about a $150 billion bank. When these banks fail, the market understands that they're, following a lot of the trends that the bigger banks are engaging in. And when these banks have trouble, they know that trouble is going up the chain. And so there's a very close relationship, a connection between these banks at the $100 billion and above level of assets and the mega bank. And so if you're loosening regulations on these lower banks, it has a lot of implications. Number one, it removes that market discipline on the bigger banks because they're more opaque, and now we don't have that early warning system. Number two, if you raise the threshold from 50 to 250, all those banks who are just under $50 billion in assets have huge incentives to buy up competitors, because now they don't have to worry about this bar at which they're going to be subject to stiffer regulations. So this is a bank consolidation bill in addition to everything else, because it's really going to cause that dynamic at the lower levels. And you're going to see a lot of community banks fold into these, larger regional stadium bank operations. Those are some of the aspects. And then, obviously, having these failures could create systemic risk. If 2 or 3 of them fail, that's equal to what a Lehman Brothers was. That's right. Equal to that kind of an event. And for this reason, Barney Frank has said he wouldn't vote for this bill. Daniel Tarullo, who was running supervision during the Dodd-Frank era at the Federal Reserve, said that's too much money. Pretty much everyone
Antonio Weiss
working.
Antonio Weiss, who was kept out of his job, I guess, at Treasury, or attempted anyways,
Treasury by
Elizabeth Warren has come out and said, like, this sounds like a bad idea. And we should be clear, too, that the promotion of the consolidation is a byproduct of this, right? But that also exacerbates the risk, because that's
right.
why
you have more connection between fewer banks, and this interconnection within the system is really what accelerated and drove the 2008 financial crisis, because it wasn't just that Lehman Brothers failed, but Lehman Brothers had counterparties at all the other banks, and so on and so on.
So we're not only taking the canary out of the coal mine, essentially, and leaving, I don't know, I guess an ostrich down there, but the ostrich also has the unintended side effect of banging its head on the rafters, making it a little less stable.
And here's where this gets even worse than the state we were in before Dodd-Frank. In theory, the Federal Reserve can say, if you're a bank with more than $100 billion, I can apply these enhanced standards to you. However, they have changed one word in the language that will make this not only impossible on these banks above $100 billion, but mega banks as well. And they've changed a word. The idea is that the Federal Reserve, before applying any kind of enhanced regulation, needs to make an assessment, a risk-based assessment, to tailor these rules to a specific bank's situation. And before this law, before S2155, it said that the Fed may apply this tailoring. They've changed one word to make it now say shall. And that sounds like nothing, to go from may to shall. However, when you make it that the Fed shall apply tailoring, now they have to go through essentially a cost-benefit analysis process on every single bank that they want to enhance the standards of regulation for. And it will create a very costly litigation situation. It will give big banks a tool to say, well, look, Federal Reserve, we don't think you did it right when you did your cost-benefit analysis to show that we needed more regulation, and we're going to take you to court for it.
Right.
And it creates a chilling effect on the Federal Reserve, such that they didn't have before Dodd-Frank and before the financial crisis, so that the Fed will think twice before adding these enhanced regulations at their discretion when they see a safety and soundness problem within these banks. And that is a huge, huge deal.
And we should say that dynamic of that chilling effect in these regulations being subject to court to suits, essentially from the lawyer, is undercut a lot of the supposed intent of Dodd-Frank in the first place. I mean, so what we're fighting over at this point, what we're talking about, are the last vestiges of something that was already somewhat, at least, compromised in structure when it was proposed. I mean, this is going back to the wake of 2008, where you had in particular
and let me say one other thing about this threshold. So this gets a little bit technical, and you can get the details at my story at The Intercept, which maybe you'll link to. But when you raise that threshold from $50 billion to $250 billion for domestic banks, it is also going to raise the threshold in all likelihood, and Treasury Secretary Steven Mnuchin confirmed this in testimony. It would raise the threshold for giant foreign banks that have operations in the United States that are less than $250 billion in assets. And that includes every major foreign bank operating in the United States except for one, HSBC. So every other bank, Barclays, Deutsche Bank, Santander, all of them would be lifted from these enhanced regulatory standards. And these are some of the biggest miscreant banks who have engaged in some of the worst practices and been fined as much as any bank in the world and we're going to lift standards on these banks. What is the rationale for these huge global operations that act like big mega banks because they are big mega banks? What is the rationale for treating them the same way that you would a tiny community bank?
And to be clear, the value of having these banks, their U.S. operations, be scrutinized is it gives us another opportunity to get a sense of what's going on out there, as it were, internationally, which is another, I guess, it's another canary.
Internationally,
it's another canary
and domestically. I mean, who is Deutsche Bank?
Right.
That's Donald Trump's personal banker, right? I mean, they've engaged in money laundering. They've engaged in tax evasion. They've engaged in transactions with sanctioned companies. I'm not just talking about Deutsche Bank right now, but all of these global banks that would be covered under this rule. Santander engaged in illegal repossessions of cars from military members serving on active duty. I mean, these are the kinds of banks that we're lifting from enhanced regulatory standards that make no sense at all.
And the CBO came out with a warning about this, I guess, today or yesterday, on Monday, I guess
it was late yesterday, yeah, and I wrote a story today. And one thing I want to highlight in that, so CBO said that this bill, because they talk about scoring a bill, they talk about the cost of the bill. And they said this bill will cost $600 million as an estimate. And that's not really very much money at all.
Nope.
Over a 10-year time frame. But the reason that they said it would cost money is because it would raise the possibility of a large bank failure or a financial crisis. That is the reason that they said it would cost money, because it would cost money to the FDIC's Deposit Insurance Fund. It would cost money to unwind these large banks that would fail. It's saying all it is saying is that this bill raises the chance of a financial crisis and the need for another bailout.
So in other words,
that is what CBO said.
That cost to the U.S. government, at least, which is, I think, sort of narrowly constructed, is a shadow of what would be cast by an event that would impact the private financial system.
They're saying that the $600 million reflects the increase in probability. It isn't a direct cost, because if we had a financial crisis, it would cost a hell of a lot more than $671 million to the U.S. government. I want to just touch on one other thing that's related to that, and that is what I've been calling the Citigroup carve-out. So this bill is supposed to be for community banks and credit unions, but what I learned is that Citigroup has been lobbying very heavily on two provisions in particular, sections 402 and 403 of the bill. And they get a little bit technical, but I'll try to explain them as best I can quickly. So one of them changes the calculation of the leverage ratio. And the leverage ratio is just a simple calculation of the equity of a bank divided by its assets. And leverage is, when it goes up, you have more opportunity for higher returns, but you also increase risk, because that equity is what you would use to cover your losses if you ever got into trouble. So in the bill, the Senate wanted to give this help to what they call custody banks, custodial banks, which are banks that don't make loans necessarily, but they hold other assets in custody and perform administrative work on them. There are only three really custodial banks in the country: Bank of New York Mellon, State Street, and Northern Trust. However, Citigroup performs custodial services, even though they're not a custody bank, and they saw this provision that would allow these custody banks essentially to raise their leverage, which means raise their returns, and thought, we want in on this action. This is unfair. We do custody stuff, even though it's not our main thing.
Right.
So we want to be able to raise our leverage too. And they got the Senate to change the definition of a custody bank so that Citigroup would have an opportunity to take advantage of that. And the CBO score says that we think that the two big banks who do perform custodial services, which is Citigroup and JP Morgan Chase, would have a 50-50 chance of being able to take advantage of this and reduce their leverage. Now, if you think, or actually increase their leverage, reduce their leverage requirement, if you think that Citigroup and JP Morgan Chase are wildly overcapitalized and need to be unshackled to take on more risk, then that's what you're voting for in this bill. That Citigroup and JP Morgan Chase should have the opportunity to make their case that they should be able to load up on more risk in the financial system. The other piece that Citigroup has been lobbying for, which they did get, is a little more technical, but it allows them to use municipal bonds to count as highly liquid assets. In case they do get into trouble, they can count them under what is called the liquidity coverage ratio, and that's supposed to be a test of how many liquid assets you have if you do run into a crisis, and these are liquid assets you can sell off very quickly and easily. Muni bonds are very thinly traded. It's difficult to trade them. And the idea that they're liquid assets is very dubious. And this also sort of
particularly in the instance, if there is a systemic financial crisis, the idea that you're going to be able to sell those muni bonds. And I mean, so that people understand, basically, there's two things that are going on here. It's basically like saying, me in Vegas, and I get to the table, and the casino is now basically saying, Mr. Seder, based on no change in your income and your ability to pay, we're now going to give you some extra chips to play with. You just got to pay us back at the end of this session. And on top of that, I now said, hey, but you guys, I also got a late, early model Subaru. And they go, oh, well, we didn't realize that. In that case, we're going to give you an extra 25% of your chips.
Nobody's buying your Subaru.
Because you can always sell your Subaru if you get in trouble.
And not only that, it hooks the entire market for Subarus into a financial crisis event, right? It hooks the municipal bond market, which had nothing to do with the situation that might have gone on with respect to any future financial crisis. So muni bonds were not related to the 2008 crisis, but if you do this thing where a bunch of banks are going to have muni bonds and want to sell them if they get into trouble, then you've added this huge market into the event. You've connected the muni bond market to the financial system in a way that is just going to ramp up risk exponentially.
Because just to be clear, because that means that they become an asset class that are considered to be a life preserver or one of the life preservers.
Prized asset class. They're considered to be like cash. Yes.
Well,
and by the way, we have scratched the surface of what's in this bill. There are weakening of mortgage regulations. There's a complete removal of regulations for the manufactured home industry, which is actually a big gift to the largest manufactured home company, like a trailer park company, which is owned by Warren Buffett. There is all sorts of really bad ideas in this bill under the guise of giving relief to community banks. So this is a huge bait and switch. They're going to be voting on it today. It looks like they have the votes, but there is sort of mounting pressure on these Democrats to abandon this bill. And if they needed another reason, the fact that the CBO says this makes a financial crisis more likely might be a good one.
And again, so much of this, at least when we talk about the 9 needed, and I would imagine King is probably also one of these guys who wants to be able to say, like, I'm doing something bipartisan. That's why I'm here. That's why.
Yeah, definitely.
And
most of them, I say, would be. I mean, look, Doug Jones is on this bill. Doug Jones is supporting this bill. The hero of the resistance, Doug Jones, who has a big regional bank, Regions Bank, right in his backyard. They're one of the stadium banks. It's the home of the Birmingham Barons of the AA, Major League Baseball. And, you know, this is just another example.
Is this, I mean, like, you know, give me a sense. Is this a elections have consequences scenario? I mean, it's not like, I mean, I think there are some people on this who are ideologically like, this is why I'm in the Senate, to make sure that banks can do well here. But I mean, if there was a different makeup of the Senate, if there was a different person in the White House who would not be so willing to sign a Republican-controlled bill, does this happen?
Yeah. I think that the turnover in the White House is a major trigger for this bill. Obviously, Trump came in and said he wanted to do a number on dodd-frank. So there's no question this bill doesn't happen without a President Trump. I think that what ends up happening with these bills, there's a pendulum, right? We have a financial crisis. We put in a bunch of regulations to try to make the system safer, and then people's memories get shorter and shorter, and then the pendulum swings back to deregulation. And usually it takes us a few years after that deregulation for another crisis to occur, and people don't normally connect that bill that happened years ago with the reason for the crisis. I mean, you know, you saw that in the financial crisis where there were a host of bills over 30 years to change the mortgage market to allow these private banks to load up on these mortgage-backed securities and create them. That really led to the crisis, but nobody sort of blamed, you know, Jake Garn, who was the author of Garn St. Germain in 1982, that was a primary contributor to creating the conditions for mortgage-backed securities. No one like went to his house and said, you were the reason that we had a financial crisis. But, you know, it's certainly more plausible than anything else. So this is the pendulum, you know, banks get into trouble, we regulate them. Everybody forgets, we deregulate them, banks get into trouble. And that's the pendulum we're on right now.
David Dayen, I wanted to talk to you about Ohio v. American Express. It is an important Supreme Court case that involves some real antitrust implications, but we will have to do that another time.
Some other time.
All right. Well, we will in fact. I've decided we will in fact link your Intercept fees.
I lobbied hard for that.
Oh yeah, you did. We changed the definition of things we would give links to, and so we were able to slide you in. Right. Under that new provision. But David Dayen, the best place for folks.
Grandfather and me.
I'm going to give like another, this is my insider tip of the day. If you want to know what David Dayen is up to, you head over to daviddayen.tumblr.com, where it's a clearinghouse of everything you are writing. Barely a day goes by where another piece is not up, and it is all over in the best publications across the internet.